Joining me now, Mohamed El-Erian, Chief Economic Advisor at Allianz. Welcome back to Fox News Sunday.
Thanks for having me, Mike.
Let's start with what went wrong. You say you see bank management issues and a lack of supervision over Silicon Valley Bank. S&P Global says SVB had 93.8% of its deposits uninsured. The average at national banks is around the 50s. So how did SVB get it so wrong, and why did regulators allow them to get it so wrong?
So three things came together in the perfect storm. One is mismanagement by SVB. Two is lapses in supervision. You had a bank that grew enormously under the nose of the Federal Reserve, and the Federal Reserve did not pay enough attention. And then a third issue that's impacting us well beyond the banking system, one of the worst policy mistakes by the Federal Reserve in the way it has handled the interest rate increases. It did nothing for a while, mischaracterizing inflation as transitory. It then realized it wasn't transitory, but still didn't do enough. And then it slammed on the brakes in one of the most pronounced interest rate hiking cycles. And that has destabilized weak institutions, weak individuals, and weak companies.
Lingering concerns over what happens now in the broader banking system. We know these two banks failed because they didn't have enough liquidity, but big banks this week also signaled some panic. Over the past 8 days, large banks borrowed $153 billion from the Federal Reserve discount window to shore up their reserves. The week before, those same banks borrowed just $4.6 billion. This indicates concern. What are your concerns?
So my concern comes from the deposit base. Look, Mike, I get lots of questions asking me, are my deposits safe? And I answer, yes, they are. And then they say, well, what do I lose if I move them to the biggest banks? Because after all, the biggest banks are too large to fail. So what we're seeing is mid-sized banks, regional banks, losing deposits to the big banks. Those regional banks need cash, so they go to the Fed window that you talked about, and that's why we've seen an explosion. But the fundamental problem is that we've destabilized the deposit base. And even though our deposits are safe, I want to stress, our deposits are safe, people think that they should be extra careful and take them to the biggest banks.
So SVB declares bankruptcy, and the U.S. promises people with money at the bank will get to keep their deposited funds, even though the bank they chose mismanaged itself and failed. Here's how William A. Galston put it this week in the Wall Street Journal. Quote, some observers fear that the decision to disregard the $250,000 cap on insured deposits could generate irresistible pressure to insure deposits fully regardless of the amount. A total guarantee, many argue, is an invitation to irresponsibility. So how do you deter banks from taking irresponsible risks to increase profits and bonuses in the future?
So first, he's right on the first bit, which is once you've relaxed the 250,000 limit for this bank, you will relax it for future banks. Otherwise, you're going to be accused of favoring the rich, favoring the tech industry. Why they did that, they had better information than I did. But once that they've done it, that's the reality. Will it lead to irresponsible behavior? That is certainly a risk. And that's why you've got to contain what's called moral hazard. You've got to make sure you supervise these banks properly. But the problem, Mike, that we're not talking about enough is twofold. One is we're going to see an increase in lending standards. We're going to see credit less available to the economy, which means another headwind to growth. And secondly, we haven't seen yet the end of the consequences of such a mishandled interest rate cycle, the biggest Fed policy mistake in 40 years.
Big national banks working hand in glove with Treasury Secretary Janet Yellen came up with a solution to make $30 billion of uninsured deposits into First Republic Bank to keep it afloat. Some finance experts say they've not seen something like this before, real teaming up of public and private sector for the good of the system. Have you ever seen a move like this, and was it the right one?
So we've seen it in the past. Yes, we have. It's what's called a private sector solution. So the private sector comes in and builds a firewall to make sure that the problem doesn't come to it. Remember, we have a strong banking system as a whole, but not every single bank is strong. So it's in the interest of the other banks to isolate the weak banks. That's the good news. The bad news is how it was designed. The money was only in there for 120 days. The government is helping for a whole year. And people very quickly said, well, that's not enough. And that's why it is not holding as yet. Hopefully it will hold, but it's not holding as yet.
We saw this week that prices are still rising. You've said the Federal Reserve's credibility is at stake and their monetary policy role is too tied up with this separate issue of Silicon Valley Bank failing. What's the balance you think they need to strike here?
So the worst thing they can do is once again blink in the eye in the front of financial instability. They've done that over and over again, and that's why we are in this problem. They should do two things. One, they should raise interest rates by 25 basis points, a quarter of a percentage point, because we have an inflation problem, and we need to get over this inflation problem. And second, they need to remind people credibly, which is going to be hard, credibly, that we have multiple tools. Interest rate policy to deal with inflation and other tools to deal with financial instability. The European Central Bank did it on Thursday. It worked there. Hopefully the Fed has enough credibility to do it here.
Do you see any signs that additional banks are at risk if the Fed does raise rates?
I worry more about the non-banks, what's called the shadow banking system, where regulation and supervision has been even worse. Yes, there is a risk that we may see a few accidents. You know, when you drive very fast on the freeway, as the Fed did, in the middle of fog, and then you panic and hit the brakes, you will cause financial accidents, and you may even cause an economic accidents in terms of a recession.
How critical is reaching a deal between UBS and its rival, Credit Suisse?
It's really important because you don't want another bank, in this case, Switzerland's second largest bank. They are now having a gun to their heads, trying to organize a shotgun wedding as happened between JP Morgan and Bear Stearns back in March 2008. I think it's going to happen, but this is a really complicated marriage that neither side is entering into willingly.
Fascinating times. Mohamed El-Erian, thank you. Thanks for breaking all this down for us today.
Thank you.
Hey everyone, I'm Emily Campagno. Catch me and my co-hosts Harris Faulkner and Kaylee McEnany on Outnumbered every weekday at 12 p.m. Eastern, or set your DVR. Also, don't forget to subscribe to the Fox News YouTube page for daily highlights.